trade barriers, foreign ownership constraints, custody issues. These are just a few of the complexities that investors encounter when moving capital across borders. Yet in emerging markets, the level of dexterity required is on a whole different level. Good morning, my name is Damian Sassower. I'm the Chief Emerging Market Fixed Income Strategist for Bloomberg Intelligence, and today I'm going to provide you with a brief glimpse into our second half outlook. So at BI, we approach the emerging markets from the perspective of a sophisticated institutional investor. Why? Because at the margin, the clearing price for illiquid assets is driven by large asset allocators. So from the perspective of an institutional investor, what is the emerging market playbook in the current environment? Or more importantly, what are the factors that are going to drive EM returns over the second half of the year? EM dollar credit. So we first of all, we must differentiate between the $2 trillion market for EM dollar credit and the $2.4 trillion market for local currency emerging market government bonds. In EM dollar credit, what we're looking at year to date is a breakdown of the three factors which drive returns. Those factors are carry, which is just coupon income, spread, which is supposed to reflect the technical and fundamental risk inherent in emerging market debt, and duration. And when we're talking about EM dollar debt, which is what we're talking about here, it's all going to be the US Treasury yield curve that we're talking about and movements therein when we talk about duration. And what we see here is over just the last 30 days, the impact of duration on EM debt returns year to date has been nothing short of spectacular. I mean, this is a complete reversal of what we witnessed just last year when rising rates led to duration losses for EM dollar investors here in the US. But as you can see, spreads have widened and the duration gains have more than offset that impact. And today, EM dollar debt is up 6.5% year to date. So what is driving the duration gains year to date? Well, over the last 30 days, we can get a bit of a glimpse of that. We would have thought that the trade tensions would have actually caused real yields to compress, i.e. growth expectations here in the US. And while we did see that over the last 3 to 4 trading sessions, it was really a compression of inflation break-evens, TIPS break-evens, that drove the collapse in US Treasury yields over the better part of the last month. And so in the orange, what you're looking at are inflation break-evens. In the white, we're looking at real yields. And at the end of the day, what is this telling us? This is telling us that despite the trade war, the markets are not pricing in a feed-on impact over the long term to US inflation. In fact, investors are more concerned about slowing US inflation than inflation rising, which is a key point here, and it's structurally supportive for all US dollar spread asset classes and EM dollar debt as well. So just finishing up on EM dollar debt, we believe we're entering a new beta regime. We believe that we're going to be entering a market where investors aren't going to be applying a higher premium to growth assets, but one where investors apply a greater premium to stable carry. We've been in this type of environment before, read 2016, and what we find is that EM high yield has some of the highest carry, some of the highest yields in dollar spread asset classes. So that might be one place to look. Now, mind you, there is a reason for that, i.e. Argentina and Turkey. But nevertheless, the yields are high, and in an environment where we believe that, hey, U.S. yield duration gains aren't going to be, they're not going to be as influential on returns over the near term, and where spreads have a tendency to probably go wider from the current levels because we're at historically tight levels. One might think that might be constructive for EM dollar credit. In fact, what you're looking at here is the fact that EM dollar debt, high yield, is the only asset class outside of US leveraged loans that have kept up with 75 basis points of Fed tightening over the past year. So shifting to EM local government bond markets. The fact of the matter is there are three factors that impact EM local debt returns, and they're decidedly different than that in EM dollar debt. They are carry, which again is coupon income in local currency terms, duration, but now we're not talking about the US yield curve. We're talking about the respective yield curves in each of the 20 markets within local currency emerging markets, and we're talking about currency. And currency dominates all other impacts. If you look back over history, currency is actually responsible for roughly 75 to 80% of local currency emerging market government bond returns over the life of whatever benchmark indices you care to shake a stick at. And look, if we are indeed going into an environment where the market's going to be applying a higher premium to stable carry, that would not necessarily be very good if your perspective on EM currencies is negative, such as ours here at BI. And so let me show you some quick things that I like to hang my hat on. And what we're looking at here is EM G7 foreign exchange volatility. And this is actually a key ratio because basically if you look at the 20-year average between that ratio, we're now 2 standard deviations above it. The fact of the matter is this is not cyclical, this is structural. We do not believe that, despite what you would hear about, the bearish dollar trade and all that's going on, that the dollar really is, going to decline over the medium to long term. In fact, we haven't really seen much evidence of that, and there's nothing in the market today that's leading us to believe that the persistent demand for dollar strength is going to wane anytime soon. And so we look at the top chart and we see, my goodness, we've reached extreme levels. And we look on the bottom and we see that the spot level, JP Morgan EM foreign exchange index, which is basically the spot level of EM currency crosses to the dollar, has fallen to record lows. Again, 2 standard deviations below its 20-year average. So this kind of feeds our conviction that dollar strength is here to stay. And that's bad for emerging market local government bond investors. So does that mean we would ignore emerging market local government debt, local currency debt altogether? Absolutely not. In fact, they have some of the highest nominal yields in all of global fixed income. And so how would we approach it? Well, obviously, we'd approach it on a currency hedged basis, and that's what you're looking at here. You're looking at the difference between the 10% country capped emerging market local currency government bond index on a hedged versus an unhedged basis from the perspective of a US dollar investor. So basically all we're doing is we're taking 1 month non-deliverable forwards and we're rolling them each and every month to get that nice, smooth, upward sloping white line, which is what everybody is after, because that's a nice, healthy, risk-adjusted return over the long term as opposed to the orange line, which is much more volatile. And as you can see now, 1,638 basis points of outperformance since the middle of 2008 for hedged versus unhedged EM local currency investors. So what does this mean? And what does this mean for the emerging markets? Well, the good news is back in 2019, active management is making a comeback in EM. In order to access these markets, you have to have both skill and, well, I just said it, you have to have access, right? So, the fact of the matter is there is going to be a premium for good performing, high quality emerging market managers in the current environment. But here are the things that we like and that, the sort of the defensive playbook as we kind of round out, my little presentation here. We like momentum-based trend following indicators because they perform well and have historically exhibited high Sharpe ratios in an environment of range-bound to negative returns in EM debt. And we like looking at minimum volatility strategies in a spread times duration framework because that will limit your drawdown, such as we've seen in other bad markets like 2015 and 2018. And so those are some of the strategies that we're looking at in emerging markets. And that's my quick review. With that in mind, I'm going to introduce you to Allison Williams, my colleague, our senior financials analyst at Bloomberg Intelligence. Thank you so much for your time.
Okay, hi everyone. Thanks for joining us today. So I'm Allison Williams. I cover the global investment banks and asset managers for Bloomberg Intelligence. And so as such, the outlook for equity markets, both globally and pockets of regional strength, is obviously key to my companies, especially in a period like the present where global macros and geopolitics are dominating the landscape. And so luckily for me and the rest of my department, we can lean on the work of our equity strategy group led by Gina Martin-Adams. And so for today, what I hope to do is to, I'll flip this through while I'm talking. So for today, what I'd like to do is just spend a few moments and talking about what that outlook is. So both globally and for the US. And to quickly summarize, the US is screening as relatively better atop the global outlook. However, the negative is, at least in terms of BI's view, is that that view is a little bit more conservative versus some of the street. So this is the global sector scorecard of the equity strategy team. And as you can see, developed market stocks are really poised for more gains versus emerging in our view. And this is really based on the fact that we see a rising dollar, falling commodity costs, an increasing breadth of price and estimate revisions for US stocks. As you can see at the bottom, there is sort of less favorable showing for companies that are more tied to trade. So Japan, Asia Pacific ex-Japan, and emerging Europe. And so as you can see from here, valuations are elevated for growth as well as certainty. So in the US, there is this combination of high profitability as well as sort of relatively lower exposure to trade, and that really sort of elevates the US in our quantitative models. India also having a strong showing here. And so then this chart sort of makes something somewhat of an obvious point, but I think it's important, which is the fact that stocks tend to follow earnings. And as you can see from this chart, which basically shows earnings of the US versus the overall world index and sort of price momentum, you can see that those generally tend to go hand in hand and again are sort of supportive of the US versus other geographic markets. And by contrast, the emerging markets, which you just heard a lot more detail about, but in our very simplistic view, when you look at emerging markets and you look at dollar, obviously there tends to be a negative correlation. And given the strength of the dollar and the expected continued rise, we think that that's going to continue to pressure the emerging markets. And so then this chart just shows you visually a point that I made earlier, which is that the US is relatively less exposed to trade, especially versus other areas of the world. So for the US, if you add together the imports and the exports, it's about 27%. The only other major region that's less than that is Brazil. However, you do see Mexico sort of lower on the list. Obviously, that's a growing concern. And China about mid-pack. And so this is a very busy chart, which really reflects a lot of work done across our department. And again, it's busy, but because I like math, I like to show the work behind the math. And basically, while there's been a lot of focus on the revenue impact of China, which we estimate could be about a 2% cut, we really sort of delved into what is the margin impact. And keeping in mind, this is before mitigating factors. We did some estimates around mid-May is when we had put this together about what we knew then, but we also did calculate what is the worst case scenario, and what we came down to was about a 50 basis point impact to margins. And we like math, but we also like simple charts. So this chart is going to show you that a lot more simply. So really, the stocks are reacting, but here is sort of the mathematical impact. We do know in terms of the overall market, and this is something that we grapple with in terms of my stocks, the global investment banks and asset managers, is that sometimes, the mathematical impact to earnings is not the only consideration. There is the consideration of, sort of the impact to markets, business health, overall GDP health, and risk premiums. And so I think that's some of the concerns that we're seeing in the US market, as well as the banks and asset managers. And so circling back to the S&P 500, so even though there is little impact to trade, it is important to note that multinationals are the weakest link for the S&P, and also, where we, and as well as consensus, is expecting sort of an acceleration of growth in the second half. But again, as a former investor, whenever I see these hockey sticks, I do get a little nervous. And so again, I think that is another concern why the market is sort of looking to sort of these trade concerns and what's next. And again, the dollar strength, we talked about sort of the risk to emerging markets, but it's also going to be core to the multinationals. And you can see this chart, which sort of lays out the relationship between the dollar and the multinational relative strength within the S&P. And so, I'll just leave you with this final chart, as I said, to begin the presentation, that when Gina's group sort of runs the numbers through their fair value model, it's really earnings growth that's going to drive the value of the S&P over the year ahead. It's about 4% earnings growth that's really going to drive the value in the next 12 months. But if you look at this estimate, she's getting about $170 worth of earnings. That's about 175 consensus. So I think that's where things sort of fall short the most. And with that, I will thank you for your time and hope you enjoy the rest of the conference. Thanks.